Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right. Back here on the Investor Coaching Show, I am Paul Winkler, as I always am, Paul Winkler. By myself today, though. Isn't that crazy? It's just nobody wanted to join me today. So, yeah, that's all right. And I can handle it. I did this for 20-something years without anybody else.
I'm right here, Paul.
Oh, hi, Nick.
Hi.
Man, you know... I appreciate it, but you're not going to talk finances with me. I know that. Although you probably could.
I can talk finances.
I bet you can now.
I just don't have anything worth contributing.
I think you always have something worth contributing. So I would beg to differ. Hey, I did get. I ran into a friend of mine, and I said, "Hey, you have any man on the street questions for me?" He's like going, yeah, roll tape. Okay, go ahead. And this was my only man on the street question for this week. This is what I need more. Folks, just go to Paul at Paul Winkler. Go to paulwinkler.com and, /questions. You can ask questions for the show. But anyway, this is worth talking about because it's a topic that's near and dear to my heart. So here was Kevin's question.
So how do you know that an investor's the right one for you? And he says everyone's telling you they're working for you. So how do you know the right one?
Okay, so question, how do you know that the person is the right one? Okay, so this is a good question in that people think that the investment industry, that there is a very high bar to get over in order to call yourself an investment advisor. Just the way the industry works, Series 65, if I want to call myself a registered investment advisor, a representative, I go past the Series 65. One of my guys that works in here, 3 weeks, that's all. He took the test 3 weeks after starting to study for it, and he could call himself a financial advisor. And you think, well, would I want somebody that is my doctor or my CPA or my attorney, knowing that they only studied for 3 weeks, that I would have them representing me? Or handling my health, or handling my taxes, or whatever. No, I would never. That would be the furthest thing from my mind. So number one, making sure that somebody is at least chartered financial consultant. Chartered financial consultant is the certified financial planner. That is the curriculum for the certified financial planner, plus a couple of other courses. Now, certified financial planner is another designation that I am. I have several of the people that work for me here. And work with me in here at Paul Winkler Inc. They're certified financial planners. It's very broad-based, dealing with taxes, dealing with estate planning, a little bit on investing, not as much on investing. And you go, well, why? And it's because the investing side of things, you think about who is sending people to these colleges to get these financial planning degrees. It's the big investment firms. It's the mutual fund companies. Who do they work for? These companies. What do these companies do? They sell product. If the college is teaching things that are contrary to what the firms that are sending students to them want taught, they're not going to send students for long. So a lot of times the teaching is a little bit light, in my humble opinion, regarding the real academics of investing. So I tend to, I'm wealth management certified professional. I'm a big fan of that designation. You don't see it very often. That's one of the ones that I went through. Very academic in nature. So that's typically what I'm doing is I'm passing that on to the people that work with me. And I am very adamant that we follow the academic research, the evidence-based research. So number one, making sure that they have financial planning degrees in the first place. Number two, and this comes from Jonathan Clements, actually from the Wall Street Journal, said this years ago. He wanted to make sure that the person received 0 commissions, nothing whatsoever. He wanted to make sure that the person was a fiduciary. That's something that's changing. People are calling themselves fiduciary. Unfortunately, the term has become watered down. There are people that will go out there and sell products, and then they'll have, this part of their practice, which is fiduciary, and another part of their practice, which is not. And you don't know The general public doesn't know when they've got the hat on, when they don't. When they actually are being a fiduciary, holding their best interest first. I want somebody that is in that type of, they're holding that out to be what they're doing all the time. So number one, I want that, all the time, no matter what. So how do I make sure nothing's done in commission? I mean, just bottom line, do you guys sell annuities? Do you sell insurance? Do you sell anything like that? Go ahead. What was that? Oh, I thought you were saying something. Sorry. So that number one is super, super important. The other thing that I would be wanting to know is what do you believe your job is, as an investment advisor? What do you do? When you choose investments, how do you choose investments? If somebody says, well, we look at historical, track records and those types of things, that tells me that's not so good because markets go up and they go down. If we have a good track record, the market has gone up and you're buying after something has done well. If you see it as analyzing companies, analyzing what areas of the market are doing or what's happening around the world, that's going to be tactical asset allocation. And sometimes you just have to read their prospectuses or read their ADVs to see if that's what they're going to do. Are they actually going to engage in tactical asset allocation? Are they going to engage in technical analysis, which is charting of the portfolio? Are they going to engage in fundamental analysis? And a lot of times, I found when I've actually interviewed and talked to financial advisors and I ask them, well, do you do this? And they'll say, well, no. And also your ADV says you do. And a lot of times they don't know. They work for a big investment firm and they don't even realize when they're recommending the products that that investment firm recommends, they don't even realize that that's what they're doing. That's what the philosophy is. So the philosophy, this is what I'm bringing up. What is the investment philosophy? Is the investment philosophy that markets are efficient or markets are inefficient? And the advisor may not know that. You might have to read the actual disclosures that they have. Another thing that I want to know is I want to make sure that they have a decent tax background. I want to make sure that they really do it. I've seen some things where investment advisors market themselves as, we're going to do tax analysis. And then I'll see stuff and then this is going to be kind of tough for you as a public to actually look at. But I'm just going to use an example. One firm that did this a lot. They've done it a lot publicly where they say, hey, you need to convert your IRAs to Roth IRAs. If you have $10,000 and you convert it to a Roth IRA, and let's say that your tax rate, let's say that it's 30%, just use a nice round number. You're going to pay $3,000 in taxes, and $7,000 is what goes into the Roth IRA. So you take your $10,000, you pay your 30%, $3,000, put it in the Roth IRA. Now you get $7,000. That beats the heck out of if you have that $10,000 and it grows to $100,000, let's say in the future, and your tax rate is 20%. And now you got to pay $20,000 in taxes. Wouldn't it be better to pay $3,000 today than pay $20,000 in the future? And people looking, well, yeah, that sounds like it makes sense, right? Yeah, pay $3,000 today. Yeah, it's way better than paying $20,000 in the future. And what they miss, and it's like these are financial people; they should know this. That $3,000, if you didn't pay it in taxes, what did my account do? It went up in value by 10 times. It went from 10,000 to 100,000, right? In my example, right? 10,000 to 100,000. Now, the taxes paid now is what? 3,000. What would it have gone up to? 30,000. 10 times, right? 3,000 to 30,000. Now, what did you pay in taxes? 20, which is you'd have 10 left over. Wouldn't that be nice to have 10 left over? And you just go, and it may even be more extreme than that. And yet it's just math. It's just not and I remember there was a guy that, oh man, people would flock all over the country to listen to him talk. And I won't name names, but I remember going to some symposiums that he put on and sitting in there, and these financial advisors were coming from everywhere, hundreds and hundreds and hundreds of them. And they would sit there and listen to this guy talk, and they go, this guy's brilliant. And he would talk about taxes in a way, and he would try to sell life insurance as an investment, as a Roth IRA replacement is what he would do. And he would talk about the tax savings of doing this. And I would shake my head and go, this guy doesn't understand the tax code, or he's just making stuff up. Because he didn't understand the graduated tax system that we were under in the United States, and was just misleading people into thinking that they're going to be in a higher tax rate in the future, when in reality, the tax system was not you avoid 30% now and you pay 30% later or 40% later. There are a lot of people that when they're in retirement pay zero taxes on a lot of their income. And then some of their income's taxed at 10%, some of it's at 12%. And there are a lot of people that would have gone and listened to him, paid 30%, 40% in taxes on their investments, only to end up avoiding a 10% rate or something like that. And to me, it was amazing that financial people fell for it. And it's unfortunate. And it's just, it happens all the time though. So making sure, real sure, that there's a high level of education. And the thing is that I think that the advisor ought to teach to where you get to the point where you understand, what am I doing? Why am I doing it? What should I expect? And what are the expectations for returns of the portfolio? And where do those numbers come from? Don't just make them up. Tell me where the return expectations come from. That Gene Fama, the guy that won the Nobel in 2013, actually what I loved about his teaching was he could tell you if you have a certain amount of money in this asset category, that he could tell you what your expected return was. He said, we can determine what the expected return is. Because if I have half my money in let's say large U.S. stocks, and let's say that the historical return of large U.S. stocks is 10, which it is, going back 100 years, and I have half my money in an asset category with a 12% expected return. Let's say that small U.S. stocks, just use as an example, because the historic return is about 12, going back 100 years. Now, if I have half my money in the one and half my money in the other, my expected return is, just keep it simple, 11%, right? It's right in the middle. Well, so I know the expected return. Why? Because I know what those companies have to pay to use your money. So therefore, I can give you an idea of what you might have in the future. Well, if you break things down based on asset mix and asset allocation, you can get a decent idea of what you might have in the future. And by the way, you can get a decent idea of how much income you can take from the portfolio in the future, because you know how you're going to change the portfolio going forward. So therefore, that is the type of information that if you get that, if you understand it, then you don't worry about this stuff, as much as you do when you're just blindly trusting the investment firm. I take firms and there was one that was a huge firm, and they were talking, there was somebody who was talking about them and said, oh, you know what, they're doing this, and it was something really, really objectionable. Let me just put it that way. And they said, did you know that they're really big in this? And I said, yeah, the firm that's number 2 behind them is probably one of the most popular investment firms out there. And they're also doing it. And just, people play off your emotions so often to try to get you to do things that you probably shouldn't do. And just being engaged some and understanding this, I think is so, so important, because you don't worry about it anymore. Time and time again, that's what I hear people say. I just don't worry about this stuff anymore. And I think that's critical. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.